Chapter 5, we delve a little further into inventories and we determine how to calculate the ending inventory and the cost of goods sold using different methods. So the merchandise inventory, like we found out last chapter, deals with all the goods that the company holds for sale. Now, what this gets into a little bit is saying sometimes that inventory is not right on, right in their store. So maybe those goods are in transit. So chapter 4, we talked about FOB destination point or FOB shipping point, and I tried to explain that if it was FOB destination, the buyer is not going to have it in their inventory or take ownership till they receive it. So then the seller would have to include it in their inventory. If it was FOB shipping point, then the buyer takes possession as soon as it ships, as soon as the carrier takes hold of it. So then they would have to include it in their inventory. There can be goods on consignment. So maybe, another store is selling the product for you, but they didn't actually purchase it, but they're just going to take a cut off of what they sell. So that company still owns those goods on consignment. Or there could be goods that are damaged or obsolete, and maybe those are either going to be counted or not counted, again, depending on their status. So again, the FOB shipping point is included in the buyer's inventory. FOB destination would be included in the seller's inventory during transit. It wouldn't get into the buyer's inventory until it arrives. Goods on consignment, it would be included in the inventory of the consignor, the person who's actually trying to have the goods sold. The consignee doesn't ever buy the inventory. They just hold it at their location and deduct some sort of fee when it gets sold. Now, so the damaged ones, if they could not go back into inventory, we're not going to value them. We're going to just charge them off to some sort of an expense or to cost of goods sold. Now, maybe though we think, okay, they could be sold, but they're going to go down in price. So we may have to reduce that sales price and then record whatever loss we would need to on that. So when we're trying to determine our inventory cost, again, this kind of ties back to last chapter as well. The cost to buy the inventory, less any cash discounts that we take. Then we're going to add any shipping we have to pay, any storage we might have to pay, insurance. Again, like I said, if it's FOB shipping point, we'd have to insure those products while they're in the carrier's possession. If we were shipping from internationally, there might be duties and other tariffs that would need to be paid. Those are all going to be included in there. So it is very important, though, to take a good physical inventory count. We'll see that if we take a poor inventory count, it's going to impact not only our balance sheet but our income statement, because we look at our goods available for sale, we compare those to the ending inventory, and the difference gets charged off to cost of goods sold. So all kind of your financial statements are going to be adversely impacted. So we want to take the best count that we can. So some good internal controls that a company could utilize to take the most accurate inventory count is to use pre-numbered inventory tickets. So then that way when they go to collect them, they know that they've accounted for every ticket handed out. The counters, the people who are actually counting the inventory, are not like the people who handle it on a regular basis. Again, because what if there was theft? They could cover for their own theft by saying, okay, I stole 2 laptops and I'm in charge of counting the laptops, so I'm going to bump that total up by 2 because I know I took 2 home. You know what I mean? So you want them to have to be independent people who are counting the product. The counters should not only look at do they exist, but look at the dollar amount and the condition, because some of the defective goods could end up back on the shelf and they really aren't worth what they should be worth. And then maybe you have a double check counter, maybe not for every item. Maybe the double checkers kind of go around and double check randomly, but just to make sure that things are being properly followed, the procedures. And then a manager confirms all of the items that are counted only once. So those would just be some internal controls. Now, what we really want to get into though is this, our inventory costing methods. So these are the 4 different ways that we can value and record our cost of goods sold and our ending inventory. So specific identification, first in, first out, which we will call FIFO, last in, first out, which we will call LIFO, and then the weighted average. So what we're doing with these different methods, specific identification obviously is like you know exactly what product it is, you know what it costs, and there's no reason to make any type of estimates. These other 3 are more estimates. So the first in, first out, or FIFO says the first ones that I purchased or that I have are the first ones that I sell. So again, if you think of like grocery stores, that would be how their goods flow. They're always looking at expiration dates. They're pulling the stuff that expires sooner out to the front, pushing the stuff that expires later out back in the back, or even keeping them back in the refrigerated section and bringing them out. You know what I mean? So they are trying to map that to say first in, first out. These first goods sold are going to be the ones that I sell first. Then what's left in my ending inventory is the stuff the older stuff. And again, when we do these, we'll have quantities. So we'll know kind of what was sold, what wasn't sold. Last in, first out says, okay, the stuff that I just purchased is the very first stuff that's going to be sold. And there's not a lot of industries that would mirror that flow. So my example that I give is like, say you're driving down Strasser there in Jackson and you pass Earthenwood. Earthenwood has big piles of mulch. I think they may have big piles of stone and other stuff too. But those are obviously ones that if the driver comes to load the mulch, he's going to take it off the top. He's not going to dig down at the bottom. He's going to take what's easiest to fill up in his truck and out he goes. So that truly would be last in, first out. But again, not a lot of businesses would flow that way. The weighted average says I'm going to take my total cost, divide it by my total units, and get an average. And then I will charge those off equally to cost of goods sold at that and ending inventory at that total. Now, companies can choose any one of these 3 methods. It does not have to follow how their goods move. It's just their choice. So then the flow of inventory will have a beginning inventory plus our purchases. That will give us what's available for sale, and it's either left in our ending inventory or it's charged out to cost of goods sold. So our inventory, again, under a perpetual system, it's going to impact our balance sheet because our ending inventory resides in our current assets, and it's going to impact our income statement because what was sold out goes to cost of goods sold. And as I said, the physical flow doesn't have to follow the cost flow. So you could be a grocery store and you could do last in, first out. Well, you know what I mean? You don't have to do first in, first out. Or you could be Earthenwood and you could do first in, first out. So it doesn't matter. It doesn't have to follow how your inventory moves. So then here's an example. So we kind of break it all out to say how many units do we have at what price point, and then that's our total costs. And then we do that for all of our purchases. So then this is what's available for sale, and this is the total cost. So then we come over here and say, okay, well, we sold 43 units. At this point, when we're doing our costing and our ending inventory, we don't really care what we sold for. If we had to do journal entries, we would care about that. But when we're doing our costing, we really just care that 43 units were sold. So if we had 55 available and 43 were sold, that's going to leave 12 in our ending inventory. So then we go through each computation individually to say, okay, if it's specific identification, we know specifically which one sold. So then we are going to say, we know what's left in our ending inventory. We had 5 of these units, this is the cost. 7 of these units, that's the cost. And we know specifically that all of these ones were sold. So we don't have to come up with any type of estimates. Our first in, first out, again, the oldest costs are the ones that are sold. They go to cost of goods sold. The most recent costs are the ones that remain and they're left in our ending inventory. So then those we're going to kind of map them out to say, okay, here's our purchases. So if we had a beginning balance of 10 units at $91, and if we sold 10, if we saw our first 20 units that are sold are going to come out of our beginning inventory, and then the other 10 are going to come out of the next purchase. So that leaves 5 of those left. Then we purchase some more at some different prices, but then we sell 20 more. So when we sell the 20 more, we go back to these first 5. Those are the first ones that we sell. Then the remaining 18 are going to come out of this tier. When I do it on the board, I do it a little bit different than, to me, they have it a little bit more, almost too much detail, maybe a little more confusing. So when I work them out, I'll do them a little bit more streamlined. So hopefully it makes it clearer. But then sometimes when you do the homework, though, they're going to provide you the chart and you will have to set it up similar to theirs. Then our LIFO, our last in, first out, says the most recent ones that we purchased are going to get charged off to cost of goods sold. They're going to be sold first. And then the older ones are going to be left in our ending inventory. So then now we go through and say, okay, these are our beginning balances and our purchased. We sold 20. Well, then we go down to our, I guess we still have to go back because these are our most recent purchases. So we have 15 at the $1.06 because those are our most recent ones. Then we take 5 into that beginning balance, but then that's going to leave 5 left at this 91. So that's what's left there. Then we buy some more, but then we sell another 23. So then we've got 10 of the most recent ones that we purchased. And then we go into that second purchase at the $115. So then when we come down and look at what's left, we've got 5 units back at our beginning balance price. And then we have 7 units back at this August 17th price, because again, here we sold out all of the August 3rd. So then we broke into that. Then this next one, we went back to the 28th. So we're kind of paying attention to our dates, but saying if these are our most recent purchased after, and they were sold after that date, those are going to be the first ones we charge to cost of goods sold. The weighted average, I always feel like it's the easiest one. So you take your total costs available and divide it by your total number available. And then you get an average cost per unit. And then you're going to charge that out. So if you sold 20 units at $100 a unit, $2,000 is what we're going to charge off to cost of goods sold. That leaves 5 units at $100 a unit left in our ending inventory. So then how does that impact our financial statements? So first in, first out, our ending inventory is going to be the most accurate. It's going to reflect our current pricing. Our last in, first out, our cost of goods sold is going to be more accurate and match our current pricing. The weighted average kind of smooths everything out so that both of them are kind of equally level. So then you can see here, looking at each one, this all deals with the same number of units that are left in ending inventory, but they're all different values. And this all represents the same ones that were sold, but they're all different values. Okay, then we get into the inventory error. So like I said, if we don't take a good physical inventory count and our inventory is understated, then our cost of goods sold is going to be overstated and our net income is understated. If our ending inventory is overstated, then our cost of goods sold is understated and our net income is overstated. What you'll see though, as you look from one year to the next, it will wash itself out. So then in the next year, you'll come in with an overstated or understated ending. That'll become your beginning inventory. And then assuming you would take a good count at the end of year 2, then it's gonna end up washing out, and over those 2 years, your cost of goods sold would be accurate and your inventory would be accurate, but those individual years are going to be off. Then our ratio for our inventory is our inventory turnover, and that is our cost of goods sold divided by our average inventory. And then the average inventory, we always take the beginning inventory plus the ending inventory and divide by 2. And then we can take that, and so let me go back, sorry. So that gives us a times. So like it might say it turns over 6 times. Then this takes it out of a times and turns it into days. So then if we take that, how I'll do it on the board is I'll take 365 and I divide it by my inventory turnover, and that will turn it into days. This does too, but again, I feel like it's a little more complex of a formula. So again, you take 365 and divide it by your inventory turnover, and then you will get your days. And here you could double check me here. Like, so if our inventory turnover is 11.8, if I take 365 and I divide that by 11.8, that gives me 30.93 times. So that's a little bit off. I wonder if it's just due to rounding, but I get like 30.9 and not 31.3. So I guess you can't do my shortcut way. I mean, because then you might miss it due to rounding. So the days in sales inventory, I guess what it does is it takes away the average, because if I flip back to this one, I'm doing average inventory. So this one just has ending inventory divided by cost of goods sold times 365, and that gives you your answer. So ignore what I said. Go ahead and do the formula that they have, ending inventory divided by cost of goods sold times 365, and that will give you your days in inventory. Because if you do it the way I verbally said, you'll be a little bit off. Okay. So that is more detail again on how to cost our inventory out.